If you are watching this, stop what you are doing. Put down your phone, turn off the distractions, and actually think about what you're seeing. Because something fundamental just shifted in the architecture of global finance, and most people are too busy arguing online to notice it. For roughly 70 years, there has been an unspoken rule in markets. The United States sits at the center of the financial solar system. When America borrows, the world lends. When America raises rates, the world adjusts. When America panics, everyone else braces for impact. The US dollar has been the reserve currency. US Treasuries have been the risk-free asset. Wall Street has been the command center. But every system that looks permanent eventually meets its stress test. Right now, that stress test has a name: Donald Trump. And on the other side of this unfolding confrontation is Mark Carney. This isn't about personalities, it's about credibility. It's about whether capital, the most skittish, self-interested force on earth, still views the United States as the ultimate safe harbor, or whether it has started scanning the horizon for an alternative. Because once money starts looking for the exit, it doesn't announce it with fireworks, it just quietly moves. Let's start with the catalyst. A report released by the Financial Stability Board in Basel sent a ripple through global markets. Normally, this body publishes dense technical assessments read primarily by central bankers and risk officers. But this time, one section cut through the noise: systemic stability rankings. For decades, the United States occupied the unquestioned top tier. The assumption was simple: American institutions are durable, predictable, and legally stable. Policy may change, but the framework endures. This time, the language shifted. The U.S. assessment flagged heightened political volatility, abrupt executive interventions in trade, and uncertainty surrounding regulatory continuity. Canada, by contrast, was cited for fiscal discipline, regulatory coherence, and leadership stability. In market terms, that language matters. Not emotionally, mechanically. Because global capital allocators, sovereign wealth funds in the Middle East, pension funds in Europe, insurance giants in Asia, are mandated to weigh systemic risk. If one jurisdiction's volatility score rises and another's declines, portfolio adjustments follow. This is not ideology, it is math. Now layer in Trump's recent posture toward Canada, public tariff threats, suggestions of tearing up trade arrangements, rhetoric that treats economic interdependence as a vulnerability rather than a strength. From a political standpoint, that may energize a base. From a capital market standpoint, it introduces optionality risk. Investors start asking, if trade rules can change overnight, what else can? That's where Carney's background becomes pivotal. Before politics, he ran the Bank of Canada through the 2008 financial crisis. Later, he became the first non-British governor of the Bank of England in centuries. He understands liquidity backstops, stress testing frameworks, and currency stabilization mechanisms at a granular level. So while Trump escalates rhetorically, Carney recalibrates structurally. Canada tightened bank stress tests. It reinforced capital buffers. It signaled regulatory alignment with the European Union to reduce friction for cross-border investors. Quiet moves, technical moves, but they communicate one thing: continuity. Markets reward continuity. Look at sovereign bond spreads. Right now, they're telling a story most people aren't noticing. For decades, U.S. 10-year Treasuries have been the gold standard: low risk, stable, reliable, the benchmark for the entire globe. When you buy a Treasury, you're essentially betting on America's stability. You're buying certainty. But what happens when that certainty cracks? Even a small deviation in the hierarchy, when U.S. Treasuries don't dominate like they used to, raises alarms. Analysts watch these spreads like hawks, and lately, the signals are flashing red. During periods of American political turbulence, the gap between U.S. yields and Canadian sovereign yields begins to shrink. That's unusual. Normally, Canadian bonds yield slightly more to compensate for being a smaller market. But when the spreads narrow, it's a warning. The market is whispering a single word: chaos. This is what they call the chaos premium. A chaos premium is simple in concept, terrifying in effect. It's the extra interest a borrower must pay because lenders perceive higher uncertainty. It's the invisible surcharge for instability. When investors start demanding it, the cost of borrowing jumps, not just for the federal government, but for corporations, municipalities, and ultimately, for citizens. Think about it. Higher yields on treasuries aren't just numbers on a screen. They are the price of trust, or in this case, the cost of distrust. Every additional basis point is money that America has to spend to convince someone, anyone, to lend it cash. And the ripple effect is immediate. Infrastructure projects slow down. Roads, bridges, power plants, projects that rely on government financing become more expensive to fund. Some get delayed, some get canceled. Mortgage rates rise. Families feel it in their monthly payments. Suddenly, buying a home costs more. Refinancing a loan costs more. The American dream becomes a little harder to reach. Corporate debt issuance suffers. Companies that rely on credit for expansion or operations now face higher borrowing costs. Plans for new factories, hiring, innovation, all are deferred because debt has become more expensive. The chaos premium isn't abstract, it's real, it's measurable, it's punishing anyone who depends on predictable markets. And it's not just America. Global investors are taking notice. Canada, Germany, Japan, anywhere safe assets exist, money flows toward perceived stability. When the US shows cracks, capital shifts. The world adjusts to uncertainty. The global economy becomes less predictable because the benchmark, the rock-solid Treasury, no longer feels rock-solid. Every political stunt, every erratic policy announcement, every crisis deepens that chaos premium. The cost is not just financial, it's strategic. It's a signal to the world that America may not be the safe harbor it once was. That perception changes behavior, investment, and the flow of global capital. Markets don't forgive instability. They price it in, dollar by dollar, basis point by basis point, and the consequences compound. This is why sovereign bond spreads matter. They are the quiet barometer of global confidence. When the US loses its edge, even slightly, the chaos premium kicks in. Borrowing costs rise, projects stall, families pay more, corporations hesitate, and the ripple becomes a wave. History shows this pattern again and again. When political turbulence meets financial markets, the chaos premium is the first, fastest, and most unforgiving signal. Ignore it at your peril. This is how geopolitics reaches your kitchen table. Then there's currency behavior. In moments of global fear, wars, pandemics, recessions, the US dollar traditionally surges. It's the default refuge. But currency markets are subtle. When volatility rises and the dollar response is muted while other stable currencies like the Canadian dollar or Swiss franc strengthen, traders take note. It suggests diversification of safe haven flows. No single movement dethrones a reserve currency, but patterns accumulate. Another indicator, talent migration. Technology firms operate on predictability. Immigration policies, research funding stability, cross-border data agreements. These determine where companies build their primary hubs. When high-value startups expand major operations in Toronto or Waterloo instead of Silicon Valley, citing visa reliability and regulatory stability, that's not symbolism. That's capital allocation. Human capital is financial capital in disguise. Carney's government introduced streamlined visa pathways for specialized tech workers. Trump's administration, meanwhile, oscillated between tightening and revising high-skilled immigration rules. Even minor uncertainty in that domain can redirect billion-dollar decisions. Real estate is another signal. International investors buy property not only for yield, but for asset protection. If legal scholars begin publicly debating the scope of executive emergency powers and asset freezes, foreign investors notice. Even if such powers are rarely used, the perceived probability matters. Money seeks jurisdictions where property rights are boringly predictable. Energy and critical minerals amplify this story. Canada possesses substantial reserves of lithium, nickel, uranium, and potash, inputs essential for electric vehicles, semiconductors, fertilizers, and defense technologies. If Ottawa signs long-term supply memoranda with Germany or Japan, prioritizing stable pricing and delivery frameworks, it builds relational leverage. Trump's approach frames energy dominance in terms of extraction volume. Carney's approach frames it in terms of supply chain reliability. Reliability scales better in a networked economy. Psychologically, this dynamic unsettles Washington because American leverage has long derived from market centrality. The assumption was access to U.S. consumers is indispensable. Therefore, policy volatility would be tolerated. But interdependence runs both ways. Auto manufacturing in Michigan depends on Canadian aluminum and parts. Agricultural supply chains depend on cross-border fertilizer inputs. Financial markets depend on confidence in Treasury issuance. When Trump threatens to upend trade agreements, domestic industries lobby furiously, not out of altruism toward Canada, but out of self-preservation. This is the paradox of leverage in an interconnected world. Pull too hard, and you strain your own system. Carney, by contrast, projects calm. No rallies, no inflammatory nicknames. Instead, quiet phone calls to London, Tokyo, Frankfurt. He positions Canada as a stable North American platform for global capital. Similar time zones, similar legal traditions, fewer headline shocks. Soft power in finance is about narrative consistency. Investors don't require perfection. They require probability distributions they can model. When executive governance becomes personalized, when policy direction hinges on mood swings or late-night social media posts, probability distributions widen. Risk managers respond accordingly. None of this means the United States collapses overnight. It remains the world's largest economy, with unparalleled military capacity and deep capital markets. But marginal shifts matter. Imagine this: foreign central banks quietly, almost imperceptibly, adjusting their reserves. Not in a headline-grabbing way, not a single day of panic, but slowly, deliberately, reducing their exposure to the US dollar. Even a small shift matters. Each dollar they remove is a subtle signal. Each tiny reallocation reduces demand for the currency that the world has long trusted. Over time, that downward pressure adds up. The dollar, once unshakable, begins to feel slightly less dominant. Then layer in sovereign wealth funds. Imagine billions quietly redirected, not into flashy Wall Street deals, not into the US, but toward Canada or Europe. Infrastructure projects in Toronto, Frankfurt, or Amsterdam suddenly look more appealing than domestic alternatives. Safer, more stable, reliable. The effect? US financing costs creep upward. Not an instant catastrophe, not a sudden crash. It's incremental, insidious, death by 1,000 basis points. Every increase barely noticed on its own, but cumulatively, it reshapes investment flows. For Americans, the consequences arrive in increments, almost imperceptibly at first. The dollar weakens, import prices climb, a gallon of fuel, a shipment of electronics, a box of cereal, everything starts costing more. Mortgage rates follow Treasury yields upward, making homes harder to afford, refinancing more expensive. Every risk premium baked into corporate debt raises the cost of expansion. Businesses hesitate, hiring slows, plans for new factories or research initiatives stall. Growth falters, not dramatically, but steadily, quietly. And yet, not all the consequences fall on U.S. shores. Canada sees immediate benefits. Its currency strengthens, capital flows in. Investors seeking stability pile into Canadian bonds, Canadian infrastructure, Canadian markets. At first glance, it looks like a windfall. But this kind of short-term gain is never free. Being perceived as a safe haven carries responsibility. Fiscal discipline, regulatory rigor, prudence in spending. Policy missteps could instantly reverse the advantage. Complacency is costly. One political miscalculation, one breach of trust, and the markets that once poured in capital can just as quickly withdraw it. Europe feels the pressure too. When money flows into perceived stability, it changes the balance of global influence. Projects in Berlin, Paris, and Stockholm suddenly gain an edge over U.S. initiatives. American investors face higher costs to compete. The market isn't punishing America for policy alone. It's pricing in perceived risk, in uncertainty, in the inability to be relied upon. This is the real danger. It's slow, it's cumulative, and it's almost invisible until the consequences are undeniable. One mortgage increase, one corporate project shelved, one currency adjustment, then another. and suddenly, what felt incremental becomes systemic. The chaos doesn't announce itself with fireworks. It seeps through every financial decision, every investment choice, every dollar lent or borrowed. Treasury yields climb, borrowing costs rise, economic expansion decelerates, employment growth slows, household budgets tighten. For Canada, the opportunity is immense, but so is the scrutiny. Every move is monitored, every policy decision analyzed. The market expects consistency, it demands stability. Fail to deliver, and the inflows reverse, the currency slides, capital flees. The advantage disappears as quickly as it appeared. This is the global chessboard, and every move matters. Each subtle shift in reserves, each tilt in sovereign investments sends ripples across continents. It's not dramatic, it's precise, and it's lethal for those unprepared. This moment also intersects with alliance structures like G7 and Five Eyes. Financial credibility is intertwined with diplomatic cohesion. If economic tensions spill into intelligence or defense cooperation, broader institutional trust could erode. That's why escalation scenarios are dangerous. Scenario 1. Trump doubles down, escalates tariffs, weaponizes emergency trade authorities, intensifies rhetoric. Markets respond with increased volatility, widening spreads, and perhaps equity sell-offs. Scenario 2. Domestic business leaders intervene. Major financial institutions pressure the administration to stabilize trade relations. Quiet recalibration follows. Scenario 3. A longer-term structural divergence emerges. Canada deepens integration with Europe and Asia, forming a stability-oriented trade bloc that circumvents U.S. unpredictability. Which path unfolds depends on political incentives and ego management. But here's the structural truth. Capital is apolitical but hypersensitive. It does not care about slogans. It cares about enforceable contracts, stable regulation, and predictable fiscal policy. Trump's brand thrives on disruption. Carney's brand thrives on continuity. In stable times, disruption can energize growth. In fragile times, it magnifies risk. There was a telling visual at a recent international finance meeting in Paris. On one side of the table, U.S. representatives forcefully argued over tariff reciprocity. On the other, Canadian and European delegates quietly reviewed draft memoranda on coordinated mineral supply frameworks. One side focused on leverage, the other focused on architecture. Long-term dominance flows from architecture. Is this the end of American financial supremacy? Not necessarily. The United States has rebounded from crises before: the Civil War, the Great Depression, the 1970s stagflation era. Institutional resilience is deeply embedded, but resilience depends on course correction. If volatility becomes normalized, if allies and investors begin structurally designing around Washington rather than through it, that centrality diminishes. For families and businesses, the lesson is simple: monitor risk diversification. Understand exposure to interest rate movements. Recognize that currency regimes evolve slowly but decisively. This isn't about cheering for Canada or condemning America. It's about recognizing that global finance is a confidence game built on institutional predictability. Carney is leveraging predictability as strategic capital. Trump is leveraging unpredictability as tactical pressure. History suggests that in capital markets, predictability compounds. So the question isn't whether one leader wins, it's whether the United States recalibrates before marginal shifts solidify into structural rebalancing. Because once reserve managers, pension boards, and sovereign funds update their models, reversing that recalibration takes years, not tweets. The world hasn't ended, the dollar hasn't collapsed, Wall Street hasn't emptied, but a subtle reweighting may be underway. And in finance, subtlety is how revolutions begin.